Hi Jeroen, welcome in the second episode of Code and Capital, our podcast. A podcast where we are talking about code. Don't worry, not too much about code today. And the financial markets. Last episode we talked about technical debt, technical debt. And today we're going to talk about asset allocation, rebalancing and total portfolio approach. And it is my pleasure to have Jeroen sitting next to me. Jeroen, you're head of total portfolio management of PGGM. Yep. Not the smallest here, 250 billion assets under management.
Depending on what's happening on the market.
Yeah, it depends. Well, today and next week. Making not necessarily you in person, but you and the team and all the people around you, 15%, roughly 15% of Dutch pension fund money is being managed through your department. And yeah, Jeroen, I would like to talk again a bit about asset allocation and the future of that today. And when I studied this topic in Amsterdam, I've been thought that like for the last decades we just look at the asset allocation and how to divide our portfolio, optimize to that. And I learned as well that about, I believe, 90% of your total portfolio return variety is depending on the asset allocation. So makes your job quite important in that sense. But I believe the theory behind it, it's already the same for a couple of decades. Can you explain to me a little bit, like, what the theory behind that is, or how do you perform the asset allocation in general?
Yeah, Kees, thank you for having me. Already a lot of questions. For me, I have a background in mathematics. I have a little bit the same surprise as I heard in your question. Of course, in mathematics, you can simply calculate everything precisely. It's a beta.
We can solve things.
We can solve things. And, of course, the economy and investment is like people making decisions. So I wouldn't expect when I started this business that there was anything that you really could calculate it exactly like maths. But how we approach it is more or less, to my surprise, also the same as with maths. You know, you have a model and then you can calculate exactly if you want this return, how much risk you have, which asset allocation is perfectly optimal, and you can calculate that till 6 digit behind the comma if wanted. So how do we do it? Traditionally a pension fund, you have a certain pension you want to give your pensioners. You have a return you have to make to be able to reach that. The pension
risk, right?
I mean, and a certain risk budget, and hopefully that fits. Otherwise, you have to raise contribution.
Because the younger the people are within the pension fund, the participants are in the pension fund, the more risk in general you can take. Yeah. Right. But so you can optimize basically for risk and return.
Yeah. And then you get an asset allocation, and that's basically what we did already for decades. And so you calculate exactly, given your population and your risk budget and your need for return, how much you have to invest in equity, how much in real estate, how much in any other asset class. And then, if you have that asset allocation, then you give it to investment managers, either within your own company or external investors. And you give them also a little risk budget, or just you say match it perfectly, and then they deliver you the equity returns and the real estate returns, etc. And then you have done your asset allocation, and that's how we do it already.
Sounds brilliant. Sounds relatively simple. Maybe your job in that sense, simple silos in asset class, but. And if we look at the asset class, for my idea, how many different asset and sub-asset classes has been divided? Because if I'm looking at my own portfolio, my own private portfolio, I say, okay, a little bit in real estate, obviously with borrowed money, with my mortgage and my house, right? Yeah. A bit of equity. Okay, in my case, it's maybe the wrong diversification because I have 90% in one share, right?
Yeah.
VI company. Investing 250 billion assets under management, that's different in terms of number of asset classes and subasset, or is it not so much different?
No, it's a little bit more difficult. Difficult and different. We invest all over the world, so we try not to invest just in the Netherlands or in Europe, but we invest all over the world, and of course in the regular asset classes like equity, real estate, bonds. But also in more alternative asset classes, which are more difficult for personal investment, like infrastructure, private equity, emerging market debt. That is like you buy the bonds of countries which are still developing, and a lot more, even more exotic asset classes for diversification.
Yeah, so if I look at the PGMs or PFZW, your client's portfolio, lots of different sub asset classes, but that means, for example, let's say, and as a total random number, but let's say 40% is in equity.
Yeah.
I mean, we did that for decades, so I guess it's going pretty well, but. There's this possibility that I would say, okay, I have 40% in equity. Let's say that then, maybe if I really look at my portfolio, then it might then be that, I don't know, for example, I have 80% or 70% exposure to the United States or to a certain sector or something like that. That's totally left out then in this case. It's potentially from a total.
No, but that's a little bit the basic and also the drawback about how we currently manage the exposures in the portfolio. You look on the long run, what's optimal, and then on the long run, it will probably be okay if you invest a lot in equity. But then, sometimes you have a great financial crisis, and then things happen. Are you on top of that? Can you deal with that on the short horizon, or do you then still have the longer horizon? That's one of the questions. And the other is that markets are not stable. You mentioned you invest in equity. If you did that 30 years ago, you have a totally different portfolio than now. If you have your exposure to equity. You're probably most exposed to indeed the US and more specifically to the Magnificent Seven, or how much it are, all. I think, and if you look in a few years, it may be all artificial intelligence you're exposed to.
And the basis behind an asset allocation is to get a well diversified portfolio. All right. But then you're well diversified, but hypothetically, indeed you could be have way too much exposure to indeed than the US or something like that. And that I see that slowly changing, and well, we invited you not for a reason, of course. We invited you because you're pretty busy with PGGM and PFZW to look at the total portfolio approach. And that's a different way of working. Can you explain to me and the people listening what the basics are, because it's already maybe difficult to understand how it works with the asset allocation, rebalancing that, and then if we talk about the portfolio approach, can you explain a little bit about that and why? Sorry, a lot of questions.
What changes is that traditionally you look at the long run, and in the long run you invest and you think everything will be okay. With the total portfolio, you try also to see what's happening outside. Should we adjust the portfolio on that? So you look more, not that everything is stable on the long run, but also what's happening now. And you look at the goals of the fund. So as I said, for the asset allocation, for example, the fund wants to make a 6% return. Well, that might be different if the interest rate is like 0 or even negative, but it was a few years ago, or whether it's very high. So maybe you have to adjust your allocation to that. And a fund can have different goals than just risk return, but also have 3D, as we call it, 3D investment, that you also have goals on sustainability. And then how are you going to allocate that? Because then the calculation is, well, risk return, and I want to have maybe some climate risk to manage. Maybe I want to have some impact, that is, you want to do some good in the real world. And how are you going to deal with that in your portfolio? The models, the traditional models, do not give an answer to that. So then you have a total portfolio approach. And you can also say, if we want to have less climate risk in our portfolio, what does that mean for the different allocations in the portfolio?
And climate and impact, you mentioned, these are factors, right?
Yeah.
But a factor can then as well be a sector, or an exposure to a certain part in the world, or it can be everything. What are the kind of factors that you're thinking of next to the impact and climate?
Yeah, you already mentioned the usual suspects, but I think also things like steerability of the portfolio, liquidity. You have certain asset classes who are not liquid at all. So how much exposure do you want to have to that, and how do you manage that? That's one of the factors we look at. We also look at, risk is not just one thing. So we look at indeed concentration risk, but also in tail risk. So what would happen if certain trends continue, or what would happen in certain stress scenarios? How are we exposed then to the different risks? So you try to manage all those different aspects of your portfolio. You try to have a dashboard, and then, for example, see, well, we're doing good on risk or good on return, but maybe not so good on our sustainability, or maybe the liquidity of the portfolio is not good enough. So how can we adjust the portfolio for that?
That sounds rather complex, right? Where it used to be, or still is, I think almost among the whole industry, or a big part of the industry. It's like, hey, we have a mandate. I know exactly what the percentages of the total portfolio should be in equity worldwide, equity emerging market, etc., etc. And if equity does really well and fixed income portfolio not so well, then I know I have to rebalance and done.
Yeah.
And if I then rebalance, so there's, in this case, money going from equity to the fixed income, let's keep it super simple, then my manager, he or she gets knows, you get more in or outflow to this part of the portfolio. That's it. That's how it was. Okay, I'm making it look way too simple how it was, but this changes everything, right? Because you can't just only rebalance then to fixed income, or...
Yeah, you still can, but you have to always think about what's then the impact on all my other things I want to steer the portfolio on.
Yeah.
So, for example, if I do that, is it still okay with my liquidity, or am I going to reach my sustainability goals? And maybe you're quite okay with normally you say, well, I need to have some more equity or some less equity because I have a target allocation of 40, and now I'm at 45, so I have to rebalance back to 40. But maybe you look at your dashboard and say, well, at this moment in time, the 45 suits me well, or
it's fine. Yeah.
Because in the end I have the risk. The risk is not too much, and I reach the goals as I have it, so I don't have to rebalance. Or maybe if I rebalance, I don't have to rebalance back to fixed income because that's underweight. But maybe I put something more in real estate, for example, because that's giving me better results in total on my portfolio.
In that way, you get basically, if I understand well, you get so much more freedom. Well, freedom is maybe not the right word, but degree of freedom. What to do? Because it used to be then like, okay, you know the percentages. You're within the mandate of the client because you get a mandate from your client, right? And done. You know, you did that part of the job well. How does it? But it must impact the whole organization then as well, or at least from your department.
Oh, the whole organization. It's really a governance question. You know, if you have the way we do it until now, then of course the board said, well, we are in control. We know exactly how much you are in each asset class and what you can do there.
Great job, Jeroen and team.
Yeah, but the question is, are you really in control? Because then a crisis happens and all equities go down and everybody say, well, we did exactly what we had to do. And nobody is responsible for looking at, well, we saw that coming. There was a question I had often after 2008. Didn't we see that coming? Yeah, maybe we did, maybe we didn't. But at least nobody was responsible for doing anything about it because we simply had to steer at the 40%. And now, so maybe a false sense of control. And now, maybe as you said, there are more degrees of freedom, but also more ways to be in control because you have your goals. And if you are with your current allocation is not giving you what you want on that certain moment in time, you have the tools to steer the portfolio.
Yeah, exactly. So you have multiple ways, indeed, multiple scenarios in that sense. But that's when you look at the board or investment committee. But if you look at from the other side, it used to be that, for example, if I would be a fixed income portfolio manager, I get my cash inflow, or at least my inflow or outflow, and then I'm relatively soon I can invest it how I think is the best for the organization or the pension fund or your client. But now it basically restricts then, I think, the mandate a bit of the portfolio manager, or is that?
No, I think more the other way around, really, because normally you are the fixed income manager.
Exactly, I'm the fixed income manager.
You have the benchmark, and they say, well, this is your benchmark, and you have to be exactly there. So if in your fixed income benchmark there's a lot of France, as we take it, there's a lot of discussion about France, and you say, well, it's in the benchmark, so I have to be there. Yeah. And with a more total portfolio approach, you say, well, this is your goal. You're the fixed income manager. You have this risk budget, this liquidity constraints, this maybe also sustainable goals. Be my guest how you manage your portfolio.
As so long more as you stay within the parameters.
Yeah.
Thanks for explaining that, Jeroen, that part of the governance part. If you look in terms of technology, obviously PGGM is using Alloc, so you guys are almost set already, more or less. But if you look at other colleagues of institutional asset managers that are not using these specific software, what kind of challenges do you think they will be looking at, or maybe you're still looking at?
I think also because data and tooling is also a challenge. You have more parameters to look at, risk return, you can do something at it.
Now you mentioned these goals, right?
But if you have also sustainability goals, that means you also have to have the data for that. That's already a challenge because, maybe on climate there is quite some data, but all the other impact goals you might have that's more of a challenge to have the data on that. And then even if you have the data, then you have to compare apples and oranges, and then how are you going to do that? So you need a dashboard. Now you have a dashboard that simply says, you have too much exposure to equity, rebalance. Yeah. And then you need a dashboard with more figures on it, more things to watch, like a cockpit of an airplane maybe. Yeah. And they say, nice, your allocation is okay, but your risk profile is not okay, or you're not meeting your sustainability goals. So
way too much exposure or the whole combination of.
Yeah. So that's one of the challenges, and the other one is that you try to be as much as possible forward-looking. So instead of just looking where am I with my asset allocation compared to where I want to be, you also want to have insights in different scenarios. And if this scenario is going to happen, is my portfolio still steerable? How does my portfolio look then? Or can I already adjust my portfolio to not be in distress if scenario X, Y, or Z happens?
Yeah, and scenario X, Y, Z, that means, for example, interest rates going up or down, or on typical exposures as well, on sector that, and we're heavy in technology now. If you follow just a normal benchmark, you're relatively heavy in the technology. If for one reason the technology sector goes completely bad,
I think
from a goal perspective then as well.
Yeah, I think standard scenarios are, of course, what if interest rates go 1% up or down, or equity goes to 10% up or down.
Yeah.
But you should also think about scenarios about what's happening with climate, or for pension fund demography and the impact on your participants, and indeed specific scenarios. It can also be geopolitical scenarios. What happens if Taiwan becomes more in the picture?
Yeah, exactly. You mentioned data. Data is what do you do when you have no data on certain asset classes, or bad data, or limited amount of data? Because I can imagine impact data or on certain private equity investments, or even for example geography, like data steal. Is that like covered worldwide, or is it then India, or is it where they only have headquarters? And so that's huge. I think that's how do you deal with that, with those data questions? I can imagine a lot of people have these.
I think we try to develop it further as more and more tooling and data becomes available.
Yeah.
So, for example, on climate, we can really steer on outcomes, because we already have so a long time now, everybody's looking at climate and net zero and Paris aligned. But for example, on biodiversity and nature, it's all very much on a sector level, and indeed. Wildfires in Colombia, in California, how much am I exposed to it? Yeah, you have to have location data on each and every asset, and of course that's not at the moment not yet available. So we use proxy and we look higher over, and then as more data becomes available, your goals are going to be, and your guidelines are going to be more granularly, and your steering is also going to be more granularly.
Yeah, so basically at least start somewhere with the data.
Yeah.
It won't be perfect yet, and not in exactly details for all the goals, but at least you have some data to steer with.
Yeah, I think that's in general the answer to a lot of the things. If you wait till things are perfect, then probably you'll never get there.
No, exactly.
So every model is just an approximation, and in this the things we just discussing, it's more obvious, of course, and then you have to be more careful.
Yeah. It's a lot of work to do, or have been done already for you then. Getting from the more traditional strategic asset allocation to total portfolio approach, that's quite a leap. Where are you right now-ish, and in terms of steps, what are the next steps for you that you're taking, if I may ask?
Yeah, I think we're still at the beginning of the journey. We, of course, have been a long time thinking about it and designing it.
Yeah.
But only the 1st of June we started really with a new organization, a new investment process model.
But that's convincing, like all the stakeholders of the end game, or the first steps towards it?
Yeah.
Or both, yeah.
Both. And I think now we are developing and having discussion about governance processes, and also see that we can deliver what we're just discussing.
Yeah, being in the driver's seat. Yeah, nice. And let's say in a year, 2 years, 3 years, you get to the ultimate TPA, total portfolio approach model, where you have it in your mind as well. What's next then? After that, is your job finished there, and that part of the job, or do you see some? If you may just dream, what's next?
I think firstly, it will take more than a couple of years to get to where we want to go with the total portfolio approach, and not just for us, but in general. It's still developing. So my job is still very much interesting for, I think, at least the next decade. After that, I think more technology comes available, more computer power.
Yeah.
So we started this discussion with that investment models are still based on something that was invented 70 years ago. because that was based where you can only do calculations. Everything has a Gaussian curve, is stationary and things like that. Well, now we have more computer power, and that means you can do more. So things like complexity theory. Make it more interesting for people to look into that, but also behavioral finance to make not just the concept, but also to make models with that will be more becoming more available.
And probably AI in that sense, of course, as well. Will it ever get there that AI will decide what the next asset allocation should be, or which factors we should invest? Ever?
I don't know. My
Maybe
gut feeling says no, but I don't know that for sure. I think AI is very good. There was a lot of data. Yeah. So searching at individual companies and so, there is still a lot of data or certain trends. But if you look at, for example, what happened to your equity return, well, we only have one realization of equity return historically. So there's only one data set. So I think that AI is less suited for that part, but who knows where it develops?
Yeah, who knows, or where we need to develop towards to eventually. We have lots of clients or talks with potential clients in Australia, superannuation funds. What I see there is that they really look at the total portfolio approach as well, but they're really some of them are just really starting or not even starting yet. Do you have advice for them or other colleagues in the Netherlands, of course, or other big asset managers? What would be a first good next step be there?
I think
to get back to.
I think there are a lot of advantages for a total portfolio approach. So then the question would be, why is not everybody going there?
Yeah, exactly.
I think because it's still rather complex, and especially on governance. So that's why you see that more sophisticated funds are moving first, but because it asks a lot about the knowledge on your board, the knowledge in your investment teams, the trust between the board and the asset manager. So I think, for example, in Australia, which you mentioned, they are very well positioned to adapt to TPA because they are very sophisticated asset managers and asset owners. Yeah. So I think they should get started and indeed with the people model, the governance model, and also the tooling.
Yeah. What I will get triggered by is the trust. Where is it specifically then, for example, the trust that needs to be there, or is it the trust just in the model?
No, it's more the trust is because now boards, you often see that they deal with almost everything. They are responsible for everything, and they deal with almost everything, and that's rather complicated and impossible. And total portfolio approach says, well, you are a board of trustees. You think about the goals, the strategy, the things on the top level, and then you have to delegate. That's where the trust comes in. The implementation and of everything to the asset manager or to your fiduciary manager, and then you give them some more degrees of freedom, and that's where the degree of trust comes in. And I think it also helps if you have the same DNA. Yeah. So if you're going to do that with a complete strange asset manager, that will never going to work. You have to have, like PFZW and PGM. Well, they have the same strategic goals. They have the same DNA, the same roots, and that helps to go there. Yeah.
Thanks. Thank you so much, Jeroen. I hope that people who are listening were able to get a little bit of a grasp of what total portfolio approach is, where that strategic asset allocation might be ending, or at least just purely that is ending in a few years or decades maybe. If you could provide us with one more last tip from your side, because you know a lot on this topic, and we just touched upon a little tiny fraction of it. If you have a tip, what would your tip be? Very general question. But.
I think it's good to explore this and to go further, because it's not like you have strategic asset allocation, you have total portfolio approach, and this one or zero. It's everybody's in a gray area somewhere in between, and to make steps towards total portfolio can really be rewarding. So look, what are the things you want to get from TPA, and which steps you can make going towards a more total portfolio approach instead of a strategic asset allocation. And that is not like a jump that you have to change everything overnight.
Yeah, and it starts with good tooling. No, it starts with governance, and from one that could be one of the good first steps. People listening now, if they have more questions, are they able to contact you, or are they allowed to contact you directly as well?
Certainly allowed to contact me, yes.
Okay, then,
I think you will provide the details.
We'll get a LinkedIn profile up for you. Well, thank you so much, Jeroen, for your time.
Thank you, Kees, for having me.
Yeah.